I'll be on the background and my mic muted and my video off, but I'll be there at the end to be able to answer any questions that anybody has during the presentation. So Kathy is the co-founder and CEO of the Real Wealth Network and specialized in teaching people how to build multi-million-dollar real estate portfolios through creative financing and planning. She is the author of the #1 bestseller, Retire Rich with Rentals, and is a frequent guest expert on such media as CNN, CNBC, Fox News, NPR, and CPS Market Watch. Welcome to this last session of the 3-day summits, Kathy. You're a great person to kind of wrap it up for us, so go ahead and take it away.
All right. Well, this is going to be fun. I'm going to talk about syndication structuring and basically how to make lots of money and not lose money. So this could be you if you structure a deal right, if you find a deal of a lifetime and you need financing to make it happen. There can be huge rewards in the back end profit, and of course along the way splitting the cash flow with the investors. So this could be you, or this could be you. So you see, I'm not really great at graphics here. I did this myself. I'm sure you could see, I don't know if you could see that, but you don't want this to be you. Lots of money and unfortunately jail time. So that's what a lot of people don't understand, is that when you start syndicating, it falls under SEC guidelines, and you got to follow the rules, and you've got to be very, very careful and cautious with other people's money. And I'm not really seeing that out there today, and that's concerning. So I'm going to go over some of the some people recently that I've met and seen at different real estate events who are now in jail. And this is one group. It was Bay Area Equity Group. They would go to events like this and talk about their kind of guarantee. Guarantee is a word you never want to use, and you certainly would never want to invest in anyone who gives you a guarantee, because there's no guarantee in investment. If you tell people there is, first of all, you're giving the wrong message, because anything could happen. Notes are probably the most, or I should say the least risk of any kind of investment, but it doesn't mean that there's a guarantee, right? Anything can happen. It's certainly the banking system could tell you all about that in 2008. There was no guarantee they were going to get bailed out. Well, big ones did. So these guys were apparently giving these guarantees of 15% returns on properties that they were selling, I think turnkey. And unfortunately, that was too high a return to guarantee, because, stuff happens and there are vacancies and there's repairs, and they couldn't fulfill. So they started to do what a lot of people do when they get themselves in trouble, over-promising and under-delivering. They decide to make up for it in ways that they shouldn't. In this case, these guys started to sell more properties, or I should say they would sell a property to more than one person. So they'd put one person on title and they'd sell a property, but then they'd sell that same property to somebody else and never record it. And I don't know how they thought they would dig themselves out of this hole. And I wasn't there. This is only what I've read. But unfortunately, a lot of times, instead of just going to the investors and saying, look, we promised you 15%, but it doesn't look like it's going to turn out that way. We're going to have to restructure. Instead of just being totally honest, a lot of times people are embarrassed and they try to do a workaround, and that workaround can get them in jail. So don't let that be you. I think a lot of times these Ponzi schemes start because people think, oh, I'll find the money somewhere else. I just got to fix this problem. I'm going to use this money to fix this problem, but I'll find, money to fix that problem I just created, and so forth. But don't do that. Just be honest. Here's another one. Many of you probably know Sean Watkins Equity Growth Group. They were out of Orange County, and he just now had to plead guilty to this scheme where they were taking investor money it seemed to be syndicating, but it looked like it was more in the form of notes. But those notes were never recorded against any properties, at least didn't appear to be so, because those investors never got their money back. And apparently Sean Watkins had like a nice new car and so forth. So again, these are just things I've heard. But he ran a pretty big RIA in Orange County. A lot of people trusted them. So again, don't misuse your trust. If you're able to start a meetup and get people to attend and put on events like this, but you don't have the integrity to be able to handle that kind of power and that kind of trust that people have on you, in you, don't do it, or get somebody else to make sure that you're making the right decisions. In this case, unfortunately, this has led to jail for Sean Watkins for taking investor money and not investing it where he said it, he would be. And finally, Phil Carter, here's another kind of friend of mine. It's somebody I knew for many years. He was selling turnkey properties in Dallas, Texas, and really those were really good properties. I mean, when we first met him, he was getting these incredible bank tapes with properties for so cheap outside of Texas, and had just a wait list of investors who wanted to buy these properties from him because he'd get them all fixed up and rented. As the foreclosure market dried up and he couldn't get these big tapes of foreclosed properties at huge discounts, he had to find a different kind of business plan, and he had all these investors that wanted deals. Once again, it could be very tempting to run out and try to find a deal when there's so much demand, but don't do it. In this case, I think he was buying, and again, on all these stories, I wasn't there, and these are just what I've read. So please go do your own research to find out what really happened in each of these cases. And what I understand with Phil is that they were buying apartments and then selling the individual units in that apartment to individual investors. So basically syndicating an apartment, but in a different way where the investor was on title for just one unit in the apartment rather than in an LLC, as joint owners of it. And I remember him coming to us and asking if that's something that Real Wealth Network would be interested in. And I said, no, absolutely not. That's concerning to me because that's just too many owners in one building making decisions that could really affect the building if they bring in the wrong tenant or don't screen properly. There should be one manager managing a building, not 50 different managers. That's a recipe for a nightmare. Anyway, it looks like maybe, I'm not sure what led him to this point where I'm guessing it was a shortage of cash flow and same kind of deal where he would take money from people in a syndication, but maybe not spend it on what was in the PPM. Maybe there wasn't even a PPM or an operating agreement. It seems that the money that he raised was spent on something other than the investment promised. So, he looks like he's in trouble. So the key here is stay out of jail. And here's how you do it. Now, not every deal goes well, but do your best to pick the right deal. Of course, that you would put your own money in or your mother's money to don't just jump on any deal because you have investors lining up to throw money at it. That's definitely the case for us. I mean, we just turned down an incredible opportunity in the opportunity zone in Reno. We were going to build an apartment there of 200 and something units. But there was just a couple of things that were questionable, not so much with the apartment or the demand or the ability for us to build it, but more with the opportunity zone details. They're just not out yet. And with the government shutdown, it's going to be delayed probably for another month. So we just don't know what those final rules are. And we're nervous to take investor money and tell them that they may not have to pay capital gain on any asset they sell, and they wouldn't have to pay capital gain on the new asset that they would invest in through us. I don't want to make that kind of statement and then find out that the tax law has changed or it's not what we thought it was, and suddenly these investors have to pay the capital gain. So we really want to wait till the final ruling comes out, which is supposed to be February, and it could be March now because it's going to take so long for us to figure out we're going to have to let go of this property. We already have $250,000 invested, but it's just not worth it. You don't want to lose investor money ever. So be transparent. Disclose everything, never guarantee returns, never guarantee anything. Everything is at risk. You just don't know what tomorrow will bring. You don't know who's going to be president in a couple of years, and that could change everything. So never guarantee. Communicate regularly. When things go well, communicate, and when things are challenging, communicate. Because you'd be surprised how understanding investors are when they know that you've given it your all, but something outside of your ability to control it went sideways. You know, you explain that to them, and they're usually pretty understanding about that, especially if it's disclosed in the original offering documents that there are certain risks. So we do entitlement deals where we acquire land, and we have to work with the city councils and city planning commissions to help us entitle the land. Now, that's a very difficult thing because we can't control politicians at all. So we let investors know, if you're going to be in our land entitlement deals, you're going to make a lot of money. It's a 15% preferred return just to start, plus a big piece of the back end profit. So our investors have made, in some cases, over 30% returns on entitlement deals, but on every single one, we have all the risks disclosed that, hey, we can't control the city planners. We can't guarantee we're going to get the approvals for this land. Of course, we normally have several different exit strategies just in case that happens. But okay, be transparent, never guarantee returns, communicate regularly, don't cover anything up, just be honest. And this is so important, run everything by your security attorney. Do not, I'm sorry, I should say securities attorney. Too many people try to do these documents on their own or through LegalZoom or something like that, or they copy someone else's PPM. They think, oh, it can't be that different. Let me tell you, it is very different. There are so many nuances and things that you couldn't possibly know, like blue sky laws, meaning that if you have a property, say in Texas, and you're getting investors from outside of Texas, there's going to be laws that maybe you didn't know about that are specific to Texas or specific to the other states where the investor money is coming from. I had a guy come to me who said, you know, I've met some of your investors, and I asked them if they wanted to invest in notes in these commercial buildings that we're buying. So the investors basically would invest, and their money would be secured in first lien position, which all sounds great. And until I asked a few more questions, he said, I'd like to be able to pay you a commission because they are from Real Wealth Network. And I said, well, wait a minute, you can't pay me a commission on a syndication. That is illegal. You can't do that. I would have to be a manager of it. So that was my first red flag that, oh, this guy doesn't really know what he's doing. And then the second one was he was blasting it all over email, and he was on radio shows talking about this amazing thing where you could invest in notes secured in a first lien position on a commercial building in Texas. And I said, wow, you know, you are, I'm assuming you filed this as a 506C because you're talking about it publicly. They said, no, it's a note, so we don't have to. It's not a security. We don't have to file with the SEC, and we don't need a PPM or any of that. I said, nope, you're wrong. This will get you in jail. And they fought me back and forth. And I said, look, you know, it's not, I don't want anything to do with this. I'm certainly not going to recommend it to anyone I know. But just for your for your welfare, talk to a securities attorney so you could stay out of jail. They did, and they found out they were doing the whole thing wrong. And they had been given advice from a very well-known podcaster who actually teaches on syndication. So that was surprising too, that that they were so certain that if someone was raising money to invest in a note, that it was not a security and didn't have to follow the SEC rules. So again, that's not true. Anytime you're raising money, anytime from somebody else, and they are not an active participant in the deal, so their only activity is investing money, it's a security. So you've got to do it right. You've got to file properly. If you don't file properly, you can, again, get yourself in big trouble. So in addition to that, the most important thing after you have filed everything properly and got the right documents in place is to make sure that you have happy investors, because they'll come back and invest more. So how do you do that? Don't chase after shiny objects. You know, just stay in your lane. Do only use other people's money when it's a deal that you're already an expert in. So stay in your lane. Don't just, maybe you flip homes and now you want to invest in apartments. Well, those are two very different things. Take a lot of different skill sets. So maybe if you've been flipping homes for many, many years and you are very good at it and you always make a profit, maybe you should get other people's money for that. But do not take a penny to invest in anything else that you aren't an expert in and you don't have a huge track record in, unless you have an expert with you as a partner, as a co-manager. For example, we are doing these entitlement deals. Like I said, it's very complicated. I would never try to do that on my own. Instead, I work with developers who have a 30 to 40 year experience doing entitlements and doing subdivision developments, because I don't have the 30 to 40 years experience in that. So those are my partners, and I can confidently say to our investors, hey, these guys have a track record. Just drive around. You can see all these buildings that they've built and all these subdivisions they've built. And here's 10 deals they've done with us where investors have made over 20%. Then I can confidently go to people and ask if they're interested in investing. But I would never otherwise, which is why we have not done a lot of deals. We've turned down a lot of deals because I just simply didn't understand them as well. And I didn't have anyone on our team that understood them. So that is definitely something we need at Real Wealth Network, is more experts on storage, self-storage or mobile home parks, someone that could really advise us. So I would never move forward on the deals that come across our desk until we had that expert in-house to partner with us and make sure it goes properly and that we've done the proper vetting. Okay, so stay in your lane, have experienced partners, run a stress test. Oh my goodness, when you are taking other people's retirement funds, I mean, this is money that they've worked so hard for, they've set aside a little bit every month, invested and been very careful about where they invested, and they entrust you now with their money. So don't run your numbers in a best case scenario pro forma. That's what I'm constantly seeing. These pro formas that will only calculate the possibility of rents rising, or the possibility of more job growth, or basically cap rates going down and values going up. I mean, you've got to run your pro formas as if a recession might be coming, because it might be in the next couple of years. A lot of people, it's like 60% of economists believe there will be a recession by 2020. So you need to calculate your numbers as if there could possibly be rent decreases. Because if rents do go down, and in certain markets they are starting to stabilize and even decrease a little bit because there's oversupply, then now you've got a lower NOI. You may have to put more money into your financing. Because of that, you don't want to have to go back to your investors with a capital call. That would be horrible. They would not be happy, and they would spread the word very quickly all over the internet. So if you want investors to come back and reinvest and tell all their friends to invest with you, make sure you run that stress test, and that you present the numbers based on, I wouldn't say worst case scenario, but almost certain scenario. And then if rents do go up and all the things happen that you're hoping for, and investors get more than you promised, they'll be so happy. But if they get less than you promised, not so much. We had an entitlement deal where investors could make, I think we'd said 15% preferred return. But in the end, the city just they wanted us to build a new street and put in a new street light, and there was so much more that they required us to do that it cut into profits, and our investors ended up with an 11.5% return versus the 15% preferred that we had been shooting for. They still came back and invested in more deals, but it was a little disappointing. Whereas if we said we were going to get an 8% return and we showed up with that 11.5% return, they would have been thrilled. So it wasn't even so much about the number, because 11% is pretty good for a totally passive investment. It was more that we didn't hit the mark. So that's the only one with this developer that we haven't. Every other deal he's done, he has presented it as kind of the almost worst case scenario. So when the final returns come, people are really excited and blown away. But he just couldn't predict that the city would be so difficult. It was in California, which is why we no longer do any building in California. And of course, keep plenty of reserves on hand, because things could go and will go different than you plan. It just always works that way. Overestimate expenses, underestimate returns. and you will have happy investors. So here's a few ways that we have structured deals and how it worked to keep the investors happy and to keep them safe, and for us to be able to make a lot of money on the back end if things go the way we plan. So back in 2009, we were able to get so many good deals from the banks, bank-owned properties, bank-owned subdivisions where banks had failed and the construction loan was gone, and we were able to pick these properties up for so cheap. So my very first syndication was Riverscape in Portland. This was 26, it was actually 27, almost finished waterfront townhomes right in the Pearl District in Portland. And we were able to buy the whole thing for $3 million when the remaining loan alone was $12 million. So we think the property was probably valued at 15 or 20 million. But we were able to get it for $3 million. So it was pretty easy for me to raise that money. I think we raised it in one presentation. People were running to the back of the room to get involved in this. Again, it was 70% complete. They were beautiful. They looked, like the picture. That's not the right picture, but we were able to just finish them out. But when we finished, there was no financing. It was 2010, and there were just no banks. They had no liquidity. So we had a really hard time. We had the buyers, but they couldn't get loans. So we found ourselves in a pickle. And at the same time, there was a lawsuit on some of the townhomes that had been built before the whole thing went into foreclosure. So there were some townhomes sold, and then the rest went into foreclosure. So those original ones, they were fighting over, it was the Great Recession. So people were fighting over everything and anything. So there was a lawsuit with the HOA. So we had to, in order to get the loans that we needed for our new buyers, we had to negotiate. We had to get out of the HOA that existed and create a new one. So all of this kind of put us behind about 8 months on sales. And then we found out that the GC cheated. The general contractor was double billing and billing us for his entire office when, this was just one of his projects. So we caught him on that, and then we had to sue him. So there were a bunch of things that happened that, made the timeline go longer and so forth, but still investors ended up with over 22% return in 2010 at the bottom of the worst part of the recession, because this particular developer that is my partner really knew how to crunch the numbers and knew how to have enough reserves in place, knew how to do the stress test and everything I said earlier, so that we could still run into all these problems and all these issues and come out ahead. So that was one. Oh, and then another thing is the way that we structure these it's a little bit different because these are development deals, but the way that we structure them to keep the investors really safe is we give the investors that 15% preferred return, which is, pretty high. And our developer didn't get a penny until the end. So basically, the longer the project took, the more the investors would make, the more the investor would make out of the developer's profit. So it really lights a fire under him to get it done and get it done quickly, because it costs more and more the longer it waits, and he makes less. So that's just one way that we structure for the investors. Now, at the same time, and here's airing my dirty laundry here, at the same time, we found another foreclosed subdivision in the Oakland Hills called Chateau Montclair. Sounds lovely, doesn't it? I hope to never, ever see Chateau Montclair again, because basically we were able to buy 9 homes, same thing, 70% complete. All we needed to do was finish out the interiors, just like the Portland deal. They had views of the San Francisco Bay and San Francisco. I mean, they were beautiful, the best school district. We were able to get them for like a third or a fourth of their value. So it just seemed like such an amazing deal, just like Portland. The difference was that we were dealing with California instead of Oregon, and the city of Oakland, and it was during the Great Recession, so many people were laid off because there was just no money. Certainly the cities didn't have money because there were so many foreclosures, so they weren't getting their taxes. So many of the city managers and planners could only work 1 or 2 or 3 days a week. They couldn't work a full week. So we were trying to get things signed off. We're trying to get this project complete, but instead they came back and said, well, so much time has gone by. There's new building codes. You're going to have to tear out those stairs because they don't meet the new building codes. And I mean, because of 1/16 of an 8-inch difference, so many things. They wanted us to drill down to make sure that the piers were done properly. And we said, well, you signed off on them. We have proof here that the city signed off. I mean, that's why the buildings exist and are standing. And they said, well, we still want proof. You're going to have to dig down to all 100 piers and make sure that they were indeed done properly. Well, that would have compromised the integrity of the foundation and the piers that were there. So, and we waited that delayed the project by 6 months because we were trying to figure out what to do and how to work around these crazy demands from the city. Finally, they said, well, if you can just find the paperwork, the original paperwork that was signed off. We're like, well, you have them and you're in the city. And they said, well, we want you to have them. And we had bought this property from IndyMac, so IndyMac didn't have it. So we had to search, and we actually found the original developer. He was a waiter in a restaurant in San Jose after he lost this property to foreclosure. And for some reason, he had kept all the documents. We found him, we paid him 10 grand, and we got the documents we needed, and we were able to move forward. But unfortunately, the time delays just made it, it just ate into our profits with all the high holding costs. Then again, same thing, we found out our GC stole from us, same thing as Portland. The difference is he sued us and he won because we fired him, but we fired him incorrectly. So instead of us winning that lawsuit, he won it. Unbelievable. Again, the building codes changed, so we had to tear out perfectly good things to meet the new building code because these properties had never had a certificate of occupancy. So on that one, the investor profit was 0, and that was very unfortunate. Many of those investors have understood we did everything we could to save that project, and they've invested in future deals because we were honest with them, because we listed all the risks in the PPM and they knew the risks. But still, you never want to, you don't want to do this twice. Now, unfortunately, that it could happen more than twice. But here's some ways to protect your investors with capital structures like this. This is a capital stack, which basically defines who has the rights to the property, to the profits, to the payouts, to the money. And it has to be spelled out in the operating agreement, in the documents, so people know who gets paid first. Both the income and profits generated from the property, it's just spelled out through the hold period and on the sale. So more importantly, it defines who has the rights to the actual asset in case of a default. As we know, at the very bottom is secured debt, and that is highest priority in the capital stack. So when you lend money, you want to make sure that your money is secured to that property, ideally in first lien position, which really, again, puts you at the top. Now, it doesn't put you above certain things like mechanics liens or tax liens, HOA liens even. So you've got to be careful about that. But still, being in first position is very good and very good for your investors. Because that's a more secure position, you can offer your investors a little bit less than like the 15%. When we do secured debt on our properties, people are going to get between 8 and 12%, not the 15% preferred, because it is secured. So depending on how low the LTV is, you know, and how far along the project is, sometimes if it's really far along and it's a low LTV, we're going to get the 8%. If there's still an entitlement process and some risk, then we'll go up to 12 or even 15% on that debt. Next is unsecured debt, and that would be a loan to the LLC, basically. That comes next in line. It's not secured, but it's a note, and therefore it takes priority. And then preferred return, like I said, in the operating documents, any of the profit, a preferred return goes first to the investors. So let's say there's a $1 million profit and investors were getting 10% and it took 2 years. Well, right off the bat, 20% of that $1 million would go to the investors. So it was 10% per year for 2 years. Then you've got a remaining $800,000 that can be split however you've defined that with the investors. So preferred return is a great position to be in as well, but it is an equity position, which means that debt comes first. So it comes with a little bit more risk, and investors should make more money, have a higher return because of that. And then, of course, all other money comes after that. So again, if you want to really offer the most safe investment, go with the note, and you could pay less too. So a lot of times, let's see if I put that on here. Here's an example of how we structured land development in Reno recently. To give you some ideas, we bought this land. I think it's like 250 lots that we got entitled, and we raised $12.5 million to acquire the land and get the entitlements. Then once we had the entitlements, we finished out the lots and sold the dark blue ones to a home builder for the same price that we paid for the entire part, all of it. So we paid $12.5 million for all of it, plus that covered entitlement fees. And then we sold off the dark blue, for the same amount, $12.5 million, which had us with the aqua and the orange lots free and clear. So this was a really great way to structure this for our investors, where now they're sitting at a zero basis. They, all the money we received from selling those lots, we're using to build the home, so we didn't have to take on any bank debt, which can be very expensive, but can also be devastating to a project if there's a recession and you can't sell homes quickly enough and you can't make that service the debt, then you can lose the property. So we're not in that position. We own free and clear at a zero basis, and the $12 million that we got from selling is now the construction loan, which is not really a loan, it's our equity. So that was a great way to structure it. Now, in this particular project, we had some investors come in as equity and some come in as debt. So when I say we didn't have any debt, we had no bank debt, but we did have my investor debt because some people wanted to invest with their self-directed IRA. And on the equity side, the projected return was about 25%, but annualized. On the debt side, we were going to pay 12%. But what's interesting is if you invest in your IRA as an equity investor into a deal like this, a development, it's an active process. We're building homes. It's not just a passive investment if you come in as equity. So if you invest with your IRA could get taxed like 50%. So you could make 25% in your IRA, but you'd end up with 12%. So instead we said, well, hey, if people are going to end up with a 12% return, let's just give them 12% return, but let's do it in a debt position. So they would actually come in as a note. They would take priority at a very low LTV. We'd give them 12%. And now that extra 12% that would have gone to taxes, that's going to go to the equity investors. So they're going to make even more. So that was a really great way to structure it, where the IRA people could come in, make the same amount they would make either way and not have to pay the UBIT taxes. And the equity investors just got an increase in their returns. So what was going to be about like I said, 26% return could be closer to 30. And here's the houses in Reno. You could check those out. It's Meridian, I think it's Meridian 180. You want to see that? Here's another entitlement one. We purchased an office building for $10 million, but we did a lease purchase. So we only had to put $1.2 million down with a 2-year close. So we had 2 years to get this office building re-entitled, rezoned for residential, because we knew that there was huge demand for residential and that the city wanted residential. So we already had approval from the city. That's why we knew it was a safe bet. So all we had to do was raise the $1.2 million for the deposit. This is a very risky deal, so I wouldn't do this unless you really had a good relationship with the city and had a lot of experience, which my partner has. So, so basically, we paid off all the tenants to leave and got them, new leases at different places so we could tear down the building and build lots and sell those to a builder. Well, it turns out one tenant wouldn't leave. See, all of our projects always have challenges. In this case, it was a real challenge. Literally, the company was called Challenge Dairy. You've probably had their butter or their milk. And Challenge Dairy proved to be a challenge. They decided not to leave. So we couldn't tear down the building, So because my developer partner had so much experience, he just said, well, hey, how about we just take one of the lots that we were going to sell to a builder, and one that's maybe by the road, and build a new office building for Challenge Dairy. They liked that idea, so we did that, and we're able to get through the project. We're able to tear down the building and finish out the lots and sell those lots to Pulte for $20 million. And this was all in a matter of less than 2 years. So investors made, like I said, some made over 40% IRR, if the ones who got their money in first. So that was another way to keep investor money at lower risk, because we only had to raise 1.2 million. We didn't have to raise the full 10 million because we had such a long time for a close where we could get all that work done and then do a double closing at the end. So we never had to even come up with that 10 million. We just the 1.2 plus a few $100,000 to finish out the lots and make that $10 million profit. Another thing that we do is make sure that any projects we have multiple exit strategies. This is so important because you just never know what's going to happen. This helps keep investors safe. A developer came to me. He has a lot of experience building in New York City, but not in Costa Rica. But he had found 800 beautiful, fertile acres of land right by the fastest growing city in Costa Rica, where there's a new international airport coming in. It's just going to be a game changer. And he wanted to build like an eco-conscious resort called Rise Costa Rica. You can look it up. It's amazing. So we raised the money, the $5 million. We bought the land. And some people might think, wow, that's risky because this developer's never developed in Costa Rica. So many developers never get anything off the ground. It just remains dirt. But we weren't worried because we knew that one of his partners was a very well-known, well-connected Costa Rican who really wanted this project to go through. So we ended up getting our entitlements in a matter of months, which never happens. One of the reasons was that we promised the government that we would plant trees. Now, most developers want to tear down trees, and we did the opposite. And Costa Rica is very eco-conscious, so they loved it. So we planted 10,000 fruit trees on the land, and that was part of what helped us get our permits so quickly. So in addition to having all those trees, now if anything went wrong where we couldn't build the houses that quickly, well, we could export organic fruits and vegetables. So it was like a side business. And then additionally, we had another side business while we're waiting to get the financing to build homes. Since we're building a resort, we thought, well, how about we just start the resort now? So we built a tent camp. It's called glamping. It's glamorous camping, like 90 campsites there that are really first class. And so the resort has already started, even though we haven't built it yet. And people love it. We have executives coming to do their executive retreats, like CEO retreats on the property, because they really like the whole glamping feel. Plus, the developer was from New York City, so he brought a New York City chef to come in and take all the food we were growing and make masterful food. And it was beautiful scenery. So anyway, that's another exit strategy where we have money coming in to cover costs. And finally, if we ever really ran into trouble, we would just sell lots. It was 800 acres, and we could sell a couple of lots for a lot of money and be able to make, keep the holding costs paid. All right, so that is just, again, one way to be able to jump in deals when using other people's money and keep their money safe. Of course, deep value add strategy, you guys all know about that. I'm sure many of you do it. Buying at a discount, improving the value, increasing rents, decreasing expenses, and selling for a profit. But there are risks to that too, and I don't know if too many people are talking about it. There's big risks, and I can tell you firsthand, big risks. City planners might not like your plans for the value add. Regulations have increased, permit fees have increased, it's causing delays. It's hard to get contractors and workers to do the improvements. There's always surprises anytime you do a renovation, especially a deep value add renovation on a big apartment building. There will be surprises. And then you have the biggest risk of the market cycle changing during the process of you doing these upgrades. So we're in the middle of that right now, and the tides are absolutely turning. I just did my 2019 market predictions that I suggest you check out. It's on our website at realwealthnetwork.com, and you can see where we are in the market cycle and why it's more important than ever to really understand these changing tides, because it's changing rapidly, and the next 10 years will not be like the last 10 years. So you really got to make sure you understand what's coming. So why do I know this about the deep value add? Because we did it and we got stuck on it. It was very difficult. We bought these apartments outside of Indianapolis, 92 units, but there was a gas pipe leak. This building was fully occupied until the gas pipe broke, and in the middle of the night, all 92 tenants had to be evacuated, and they were not allowed to be moved back in until it was fixed. And it was an older building, and that meant doing a lot of digging. And in the digging process, the city planners decided, oh, there's a whole bunch of things we want you to do new water mains, and they found some mold. They wanted that remediated. Termites, they wanted that fixed. Of course, we did too. All these issues came up in the process. So it took a couple of years to be able to meet all the demands of the city. And we ran out of money. We had to raise more money, and then we had to get a loan. It was just extremely difficult. And of course, other people's money and their retirement money. So huge challenge on my part, but I just kept being honest with them and explaining what was happening and that there were all these unforeseen things. But in the end, they did not make any profit on this. And that was really, again, a second time. So it's like, I'm not going to have a third time. And that's why now we are just more cautious than ever. Like I said, we just passed on a really great apartment build because we just want to make sure we have all ducks in a row. And we've had probably 20, at least, projects that have gone really well and exceeded our expectations. But these are the two that didn't. And I just want to make sure you understand that, because too many people are jumping into syndications thinking that just nothing can go wrong. And I'm here to tell you a lot can go wrong, and you need to be prepared for it. You need to have the reserves. You need to disclose everything. You need to have all risk disclosed in the PPM and the operating agreement so that there's no surprise. Okay, well, if you're not sure how to find me, I have a podcast called The Real Wealth Show, and also Real Estate News. On The Real Wealth Show, I interview people, and on Real Estate News, I give daily news updates. So it's free, and also Real Wealth Network is free to join as well. All right, any questions? I'm not sure if I'm able to take questions, Dan.
Yep. You can have some questions. So as you guys are listening right now, I'm sure you might have a few questions for Kathy. Go ahead and type it into the Q&A box, and I'll tee them up for her. We do have one already in there for you to be able to explain what the difference is between equity investment versus debt.
Okay, yeah, sure. It would be the same as, I'll really simplify it. Let's say you bought a house and you were going to flip that house, right? And so it was a $100,000 house, and you got an 80% loan to value. So you went to the bank, and the bank loaned you 80%, and you put down 20%. So the bank is clearly the debt. It's the lender. And you put the $20,000 in, you own the equity. So you're the equity investor, and the bank is the lender. They are the debt side. Now, the bank, again, depending on the way things go, the bank tends to be the most secure, because what if the bank only lent $50,000 and you put $50,000 in? Now there it is, such a low LTV, the bank is really secure, right? But what if you invested a little more money, fixed it up, and now the property's worth $200,000? You just made $100,000. The bank didn't. That all went to you as the equity investor. You get all the equity, and the bank doesn't. The bank just gets its interest rate, which could be 6%, 5%, 10%, whatever it is. That's all they get. Now, that's when things go well. It's when things go well, you want to be the equity investor. If you want to be super secure, you want to be debt. You want to be the lender. But let's say you bought that $100,000 property, you put your $20,000 in, the bank lent $80,000, and the recession hit, and then you had to do all these repairs, and then you had a flood and you didn't have flood insurance, and all these things went wrong, and now your property's worth $50,000. Well, you lost your $20,000, right? Like, that equity is gone. So, the equity investor has a bigger chance, has the chance of losing everything too, because if the value goes down, the money's gone. Now the bank has priority. So even if the property is only worth $50,000, all that goes to the bank. The equity investor gets nothing. So obviously that would be a loss for the bank too, which is why if you want to be super secure, you go in with a really low LTV. But generally, we don't see those kind of losses unless it's like I said, a deep value add with all kinds of surprises you didn't expect. Right. Any other questions?
Yes, there was another question on here. It's how do you rehab/add value to your apartments efficiently when there are already tenants living in them?
You wait till they leave, I guess. That's the way, a strategy that a lot of people use is as there are vacancies, you fix those units up. Or you would move the tenants out to a different side of the building and do half the building. Like the Arbor Village one I showed you, those were different blocks of buildings, so you could just work on one block while the rest are rented. But Dan, you probably have a better answer to that than me, but that's the way I've always understood it.
Yeah. That's definitely, what we would approach it as well. And when you're, creating and putting together your underwriting, that's why the rent roll is very important, because when you're projecting your increase in your rents, you can't just do a yearly increase in rent. You have to break it down by month and when those leases are coming up for renewal, so that you can project, okay, this month I have 8 leases coming up, so I can get 8 of them renovated. It's going to take me 2 weeks, and how long it's going to take to get those back online. And then the next month you might have 15, or you might only have 2. And so you have to base your underwriting on that same thing. One strategy we've used in the past is when you're doing those turnovers to give the tenant the option to stay in the unit, not stay in the unit, but stay on the complex if they want to pay the premium on the renovated unit. But we just basically will not charge them, but we'll move all their belongings to the new renovated unit if they want to stay. And so we don't ever renovate a unit while the tenant is living there, because of the liability of things being broken inside the unit, or somebody leaving out a hammer or a screwdriver and they getting injured, and it just increases some more of the liability. So either waiting until they leave leaving from when the lease comes up, or moving them into a newly renovated unit is kind of the strategy we've used.
Yeah, the hardest thing is to have an empty building. And that was the case we had with this gas pipe leak. So we had an empty building, and you would think, well, that's great, we could just renovate the whole thing. But a lot of tenants see it as a really wonderful opportunity to steal. So that was another thing that we went through, is that when we do a renovation, we'd have people break in and steal our appliances and everything because it was vacant. So it's much better to just renovate a few units as you go.
Yep, absolutely. Can you return back to the previous slide so they can know how to get a hold of you and contact you while we're going over these questions? Perfect,
Sure.
Perfect. All right. Next question is, you mentioned that you had a 2019 predictions for the market. Can you go over a couple of the high-level pieces of that?
Oh, absolutely. The main thing to understand is that we really have to follow and pay attention to what the government is doing and what the Federal Reserve is doing. Because at the end of the day, growth happens because of stimulus, and recessions happen because of a tightening. So if you watch my presentation, you'll see almost every time a recession came, it was because the Federal Reserve started raising interest rates. As you probably know, the Fed raised rates 4 times last year. And not nobody, but a lot of people thought they wouldn't do that last rate hike in December, but they did. And boy, did the stock market react, and we had, a huge drop in the stock market because of the fear around that. So to just sum it up, when we had our massive Great Recession, the economy flatlined, and the way the government tried to fix it was by all this stimulus, keeping interest rates low by buying bonds, keeping Fed fund rates low so that banks could borrow for almost zero rates, and so could corporations. Again, this is a stimulus, and it worked. The housing market reinflated, and obviously the stock market did as well. Then about 2 years ago, the Federal Reserve said, okay, great. It's the economy's chugging along. Now we got to do the opposite. We've got to start tightening. So instead of having low interest rates, they start raising rates in an attempt to slow things down. It's moving too fast. And when things move too fast in an economy, prices go up too fast. And some of the things that you have to look for is low unemployment. Everybody's saying, wow, isn't this great? We've got low unemployment. What it means is more inflation, because employers have to pay people more because there's so many job openings. There's like 7 million job openings or something right now. So many job openings. So to get an employee, companies have to pay more. And that creates inflation, which is not necessarily good for the economy, because we don't want to pay more for stuff, right? If we have to pay people more, it's not the corporation that's going to absorb that, it's the consumer. It's going to be passed on to the consumer. So right now we have very low unemployment. We have tariffs. We've got, fees and costs going up, rates going up. So we're starting to see this kind of inflation that has the Fed want to raise rates even faster and slow things down. Now, historically, they have not done it well. So usually when they start raising rates, they raise too fast and it starts a recession. Every single time you'll see those slides. So when they raised rates in December, that's why Wall Street freaked out, because like, oh man, they're doing this too quickly and it's going to have the whole economy tumble. So just be aware, when the Federal Reserve is stimulating the economy, meaning lower rates, you're going to see a stimulus. You're going to see the economy like pick up. When you see them tightening, you're going to see it slow down. So in the last 6 months, we saw housing slow down. Now, the headlines are saying, oh my gosh, the housing market's struggling. That's not the case at all. It's stabilizing. It's the speed of sales is slowing down, but the prices are still going up. But we saw the slowdown because rates are going up, because the tightening is happening. So again, you've got to pay attention to the Federal Reserve as the most important thing moving forward, because the last 10 years were all about stimulus, growing the economy. Now the Federal Reserve is trying to slow that down. So don't count on rents continuing to rise. Don't count on prices continuing to rise. Prepare for the possibility of recession and what that would look like to your numbers, because right now you have the chance to reorganize and move your portfolio around to prepare for it. And believe me, you can prepare. You could ride right through any recession, just like we did back in 2008. We were telling people, hey, sell all your high-priced, overpriced stuff, reposition and get into Texas, where there was so much job growth, but property values were way undervalued by 26%. So you could sell at the peak and buy at the trough at the same time and not even feel the recession. So a lot of the people who listened to the Real Wealth Show, not because of me, but because my guests are brilliant. I have people like Robert Kiyosaki on and Peter Schiff and, just big time players who could see these market shifts happening. So don't be afraid of recessions. You can totally reposition yourself to prepare for it and skate right through it.
So then this next one is actually a compliment that says, we did not have any syndicator talk about how investments could go bad with passive investor funds. You shared this. We appreciate that. So thank you for that.
You're welcome. It's really hard to lose people's money, and I don't want to see anybody else do it. I don't want to see anybody lose money. And what I've seen right now is a trend of people taking it way too lightly. I'm really lucky that my investors knew I did everything I could, and they know that I got them into deals. I let them be the first to get into deals that we didn't have enough space for. What should I say, like deals where we only had to raise $2 million and we'd raise it like that. So we let them in first, and they were able to make their money back over time. As they continue to trust me, again, because of all the things I said, the transparency. But again, too many people try to cover it up and they get themselves in trouble. So I hope I saved some syndicators and some investors from my stories, my bad luck stories.
That's one of the biggest things with investors is communication. It's when they find out when it's too late that it really will tick off an investor. So even if something's not going right on a property or an investment, inform them along the process. Tell them exactly what you're doing, because the investors will understand when they realize, hey, this is happening and this is what I'm doing to try to mitigate the risk and trying to fix the issue. But it's when you just don't communicate was when you have that major problem.
Yeah, I did. I'm from the Silicon Valley, and I'm around all the tech startups, and somebody came to me with this amazing tech idea for housing, and thought, wow, I really like this. I really like this. But you know what? Tech companies fail more than they don't, you know? So I had an investor meeting, accredited investors only. And I said, look, I've got this tech thing. I think it's amazing. It's got some really big names in it, but most businesses fail. So if you want to invest in this, you have to understand that you may not get your money back. That's just the way it is. And I don't want you coming to me saying, oh, I lost your money because I'm going to let you right now. This is speculative, and you probably will lose your money. And you know what? We still raised $6 million for it. So in the end, as we went forward with it, I realized, oh man, this isn't going anywhere. And I was able to freeze the whole thing and get almost all the money back. Investors lost like 4. But they were thrilled. They're like, oh my gosh, you said we'd lose everything and we got most of it back. It wasn't going well. So again, you just disclose, be clear from the beginning what the risks are, and then people aren't surprised.
Yep. Next question here is there anywhere that we can read about your Costa Rica project experience? It sounds very interesting in a creative case.
Oh, absolutely. It's such a cool project. I'm actually taking people there at the end of March. We're going to do a tour. Real Wealth Crowd is our crowdfunding page, and you'll find out information there, realwealthcrowd.com. And if you want to actually see the website for the project, it's risecostarica.com. But on Real Wealth Crowd page, you'll find out about, I think we've got it posted on our upcoming tour, but it's basically the last weekend in March. And I think we'll be there in beginning of April as well. Just, showing you around, letting you see all that's happening in that part of Costa Rica. And the homes we're building, if you don't want to be a part of the syndication, which actually pays really well, it's 18% preferred because it's overseas. I think it's really important to diversify overseas given that crazy, crazy national debt. Let's see. Yeah, what was I going to say? Yeah, Rise Costa Rica.
And I put both of those links in the chat box for those of you who are interested as well, so you can have an easy link over there.
Thank you.
Yeah. The other question here is do you foresee doing more construction deals versus other asset classes, and do you prefer multifamily still or net lease?
It's a great question. The biggest payout we've seen for investors and for the syndicators and the developers, everybody, has been entitlement because it is risky. It's just that I am aligned with developers who really understand it, know how to do it, and get it done quickly. So we have a really big track record for that. So I love entitlement deals with these particular developers. There is a desperate need for housing. We're still not building enough houses to meet demand. For example, in Reno, you've got Tesla there, you've got Amazon and Switch and all these high-tech companies that are wanting to go to Nevada instead of Silicon Valley because they pay no tax in Nevada. It's only 3-4 hours away from San Jose and San Francisco. So this massive growth in Reno, but it's mountainous and it's difficult to build. And there's winter there. So you can't build as quickly as you could in California. So I think there's a demand for 6,500 new homes every year, and developers are bringing on maybe 4,000 or so. So there's desperate need. So our little 250 home subdivision is just a drop in the bucket. It's barely going to meet demand. So there is just a great opportunity to build right now. If you can bring it in at a somewhat affordable level. These homes are going to be between 500,000 and $1 million, which for people from San Francisco is nothing. Because you saw the pictures; they're gorgeous, beautiful homes for between 500,000 and $1 million, which would be really just a shack in San Francisco. So it's affordable for them and for the tech people that will be moving there. But if you can build affordable housing, there is tremendous demand. Another incredible opportunity is still taking older homes, renovating them, and making them really nice, because you can probably do that for less than the cost to build. So you're able to provide affordable housing, and so we see that as still a huge opportunity. And with multifamily, the same thing. Now, I happen to have a horrible experience with an older property in multifamily, a deep value add. I know a lot of people that have presented have had great experiences with it. But for us, I think our specialty is more in building. I'd rather just build a brand new apartment and we're doing that. Well, I'll take that back. In Mountain View, we bought a 200 unit building across from Google headquarters, and it is a whopping 1 cap. It was like just a joke. And we syndicated it, and it was like $150 million purchase, but it was across from Google in Mountain View. Now, our plan was obviously not to make 1%, because, you know, the syndicator's got to make something, you got to carve that up. There's not much left. Our plan was to re-entitle it and increase to 800 units, which we got entitled, and we are going to be building, you know, tearing down the building and building 800 units. So, so sometimes we'll do that where we buy an existing unit just so that during the entitlement process we're getting some income, and then when we've got everything in place in the entitlement, then we're going to tear the whole thing down and build a new one. So I definitely am more of a fan of building at this time. But, you know, I know there's some good people who presented who have lots of other opinions.
Sure. And that's the nice thing about an event like this is you get to have opinions from lots of different people. So that's great. Do you foresee doing more? Oh, we already asked that question. Let me get that one over there. Do you see A-class properties at higher risk for the next recession?
You know, this has been interesting because I talk to a lot of high-level people. I'm so lucky to be in that position to interview just about anybody I want to talk to. And I'm on panels at big conferences with people. So I'm constantly asking people who have been there in the past and past recessions, what it was like, you know, where was the safest place to be? Like I said, for us, we were telling people, sell your California property in 2005, 2006 at the peak and buy in Texas that was just beginning its boom so you could cash out and invest. So, oh my gosh, I think I just forgot the question. What was it again?
It was about, do you see A-class properties at higher risk for the next recession?
So we were able to sell C-class gross California properties for like $400,000 and buy a, you know, brand new property for $100,000 and buy like 4 of them at A-class. So this is what I was saying is it's this incredible time where you can sell your junk because someone's going to buy it. Like people are crazy out there. They're buying anything. So sell your junk and reposition and get into maybe a B-class or an A-class. What I've been told by all of these people who have been through downturns and struggled through them or skated through them was that generally, if there's a lot of job losses, then A-class tenants can't really afford A-class anymore and they downsize to B. And then, but everything kind of gets cheaper. So sometimes the C-class is able to now afford the B-class. So what I've heard is that during a recession, the B-class is usually the best place to be, or nice C-class. You know, there's always going to be certain A-class property that does great no matter what. If it's, like I said, this one by Google, that's recession proof, right? I mean, there's always, Google's growing, so we're not worried about that. That's an A-class property. So again, it just depends, and it always depends on jobs. So if you've got something like that where these jobs are not going anywhere, then you'll be fine in an A-class. But otherwise, like I said, most people are telling me that B-class is a pretty safe place to be.
Do you know what the average inflation rate that the government is trying to keep it at always in all these cycles to keep it at equilibrium?
They are saying 2%, and we're right around there. So we're not supposedly seeing massive inflation, but we are way past that in housing, right? It's been, you know, in some cases double digits still. Definitely on a national level, about 6%. So inflation in housing has been out of control. So when you see the headline saying it's slowing down, it's actually really a good thing. It's just normalizing and stabilizing. But 2% is the target for the Fed.
A kind of a follow-up to this one is what's the high and the low inflation rates when the Fed start taking action? What's the high and lows and median for inflation rates, and kind of explain a little bit?
The Fed is raising rates, and their target has been 2%. And in some cases, we haven't even hit that 2%, and they raised rates. They raised 4 times last year. So what are they really looking at? You know, why are they deciding to raise rates when it seems to be right within where it's supposed to be? I don't have the answer to that question. I know that President Trump really fought with the Fed. He did not want them raising rates in December. They did it anyway. So you have 2 really important influencers, the government and the Federal Reserve, and they are not the same. The Federal Reserve is not federal, and it has no reserves. It is the banking system, basically. It's basically banks. the big banks. And they have the ability to create money and lend it to the government. So the government kind of created the Federal Reserve as a way to get more money, because the Constitution says the government can't just make money, but the banks can. They can make money and the government can borrow it. So that's kind of what that situation is. But they are very much at odds right now. When I was on a national news show where they did this housing in review for 2018, it was, I think, RT America or something. They said, how would you summarize 2018? And I said, it is a year of opposing agendas, because you've got the Trump administration trying to stimulate the economy with tax cuts and trying to create jobs, when in fact we have too many jobs. We have more jobs than we have people. Like I said, 7 million openings. And we are kind of at the tail end of an expansion. So this is normally not the time that you do all the stimulus. You do the stimulus at the beginning. So we're sort of at the tail end. So you've got the Fed trying to slow things down, and you've got the president trying to expand the economy, and they're at odds. We've got stimulus and tightening happening at the very same time. So the tax cut stimulated while the Fed was trying to slow it down. So a lot of people think the Fed's going to win this battle, that they are going to, the Fed gets what the Fed wants, and they are wanting to slow things down regardless of what the president is trying to do.
Another thought on this just came through of if we have high inflation, wouldn't the prices of hard assets rise with it, such as gold, silver, and real estate?
Yes, usually. Well, usually. It just depends. We have had massive inflation in housing. So that's why everything's kind of out of the price range, but not so much in gold and silver. So it comes back to supply and demand. Right now, we have still tremendous demand for housing, and that's what's kind of keeping it going. And as more supply comes online, we would start to see that pull back, but we're not even close. There's record household formation. We have 25 million more people in the U.S. than we did 10 years ago. So, and when builders just stopped building for 5 or 6 years, so we need more housing. And as long as there's that massive demand, not enough supply, we're gonna see the housing market remain stable, in my opinion.
So the next question is here. Great to see you with international opportunities. How do you shortlist any overseas opportunities that come to you?
We get so many now that we've been involved in Belize and Nicaragua and Costa Rica. Costa Rica definitely being my favorite. I would love to learn more about international investing, honestly. And I have an advisor, Scott Stay, who actually I interviewed on the Real Wealth Show, and he gave some wonderful tips about what to look for. If you are looking to invest overseas, I can tell you my husband and I lost money. Boy, here I go again. You think that all I've ever done is lost money. We've actually done some really good deals. But we bought this waterfront condo in Nicaragua. Nicaragua is now very unstable, so we took a risk there. But also the developer just never got it off the ground. And so we own a bunch of waterfront with nothing built yet in Nicaragua. But like I said, with Costa Rica, we're already breaking ground. We're already building houses. It's moving along so quickly because we have the right relationships and we picked the right country that has much lower risk. It's been stable for a very long time, and it seems to have some kind of alliance with the U.S. The U.S. protects Costa Rica, is the way I understand it. So I would love to. I know there's opportunity in Spain right now to buy, in Italy. I mean, there are opportunities to buy. The most important thing is that you understand the differences and have somebody local help you with that, so that you don't get ripped off. It'd be pretty easy to get ripped off if you don't have that local expert to help you. So if you were going to invest in a development, like our Costa Rica development, we have partners who are highly experienced developers from Costa Rica and know the system and know how to get things done clearly, because they're getting done. But don't invest in somebody who's doing it for the first time or doesn't have the track record, because you probably never see your money again.
Well, Kathy, I want to thank you very much for joining us today. Do you have any final words that you want to leave us with before we wrap it up?
I mean, the final word is just like I said in my New Year predictions, that if you are in the housing space, if you are offering rental property and you're in the right place near jobs and where there's demand, I mean, there's going to be demand for years to come. Probably for the next decade will be massive rental demand, mainly because of the the debt, not only the national debt, that's a big problem, but consumer debt is at all-time highs, student loan debt, all-time highs. The people who are supposed to be buying are in their early 30s. That's normally when people buy their first home. They're not going to have their student loan debt paid off till they're in their 40s. It is record high. So even if they wanted to buy, their debt to income ratios are just they're not there. So with housing prices up, interest rates up, debt up, people are going to have a harder and harder time buying, which means they're going to be renting. So we think, along with hedge funds, I've been to a lot of hedge fund conferences where they're upping their game. They probably own about 1% to 2% of the industry right now in single family rentals, and they are planning on increasing that by up to 10%. So because we're also seeing more demand for single family rentals. So there's going to be massive demand. If you are in multifamily, which obviously you are because you're on this webinar, you've been listening and are interested, just, be aware, make sure you truly understand how many new multifamily properties might be coming online in your area. Make sure you really understand permits and so that you're not investing in an oversaturated market or a market that could become oversaturated. That would be the biggest risk moving forward. But other than that, as long as they're in an area with job growth and population growth, again, there's going to be rental demand for the next decade.
Yeah. Well, thank you again so much, Kathy, for joining us. I really appreciate you taking the time to be with us. I wish you a good rest of your weekend, and we'll be in touch.
All right. Thank you so much.
Thank you.
Bye-bye.
All right, that concludes the Multifamily Investor Nation Summit for January 2019. I really appreciate each one of you being here and being attentive during all 3 days of the session. Room 2 has now been completed and wrapped up, and I just want to again just extend a thank you to you for joining us, and also would appreciate if you would go ahead and go to nextmfin.com and go ahead and register for your tickets. We'll leave that registration page open just a little bit longer. So for those of you guys want to jump in there and get the lowest price of $97, you can. And also you can upgrade for half price to the VIP for only $100. So for $197, you get VIP access to include yourself in all the pre-event masterminds. And we're also going to be making it even bigger and better. So that will be the lowest price you'll be able to get it at, even if some of you might have bought an add-on ticket or something like that. So thank you guys so much for attending. And also, please go fill out your survey. Go to go to MFINsurvey.com to fill that out. So thank you guys so much for joining us. I really wish you the very best, and thank you for all the comments and compliments that are coming through. I really do appreciate each one of you following us, and I also would appreciate it if you would take a picture, or if you already did, of where you're where you're viewing everything, and just post it on your Facebook and tag Multifamily Investor Nation. That would be really appreciative to help us kind of get the word out for the next one. And just again, thank you so much for each one of you being here, and looking forward to seeing you at the next summit. Have a good rest of your weekend.